What is the best type of loan for you as a home buyer or first-time home buyer?
Such a broad topic, and we're going to break it down into talking about the four things, the four conventional, FHA, VA, USDA, talk about the four major loan types that are out there, and then we're going to talk about the generalities of it. However, I want to preface this video and say every situation is unique, and you and your lender should pick the best product for you based on your situation that you're having at hand. So when we say this might be better than this one, don't take it as a slight, because all four are great products meant for specific situations. So there's no right mortgage base, the best mortgage out there, and then the rest of them are bad. That's not true. They're all good. So we just kind of want to start with that, and then we should talk a little bit about conventional.
Yes, and I just wanted to add that this four category is under the umbrella of the qualified mortgage, which really is a guideline from the Federal Housing Authority and Fannie Mae and Freddie Mac. And now, what we wanted to start with?
I want to really kind of just start brushing base and start talking about conventional loan, because that way people get a feel of what we're talking about. So, conventional loans are bank-run loans. So this is not necessarily run by any sort of government program. This is going to be for a wide audience of people.
Exactly.
And here's the thing: you generally need 620 for a FICO score. So when you look at your FICO score, you should have at least a 620. What's the benefits of this one?
Well, you could be like a first-time home buyer, second home buyer, investor. What else?
Vacation?
Or vacation homes. You can use this type of loan for all these different categories of the home buying.
Right, and what kind of down payment do you need?
And people had the misconception that you need to put the 20%, but really, according to the guideline, is 3%. But some of the financial institutions, they want 5%. But the good thing is,
even with this economy, because interest rates are so high, there are some lenders allowing you to go in with 1%. So that's crazy low, right, for a down payment. However, your credit score has to be there. Now, before we start talking about the negatives and what going less than 20% is, I think we should do our introduction, don't you?
Exactly. And let's
hit it. Hi, it's Alan Victoria. Welcome to our Tailend Podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Honestly, you call and text all the time at 252-327-3357. We love talking to you. Do not be shy. Also, don't forget our buyer's guide and seller's guide in the description below.
Exactly. And what we're going to talk about, the conventional loan.
I think you need to start talking about PMI.
PMI, basically private mortgage insurance, or PMI, basically is things that people actually have the misconception of the 20% down payment. That meaning that if your loan to value ratio, that they call it LTV, is going 20% or above, you don't need to pay that private mortgage insurance.
Right.
But if you put less than 20% down payment, this PMI is going to be part of your monthly payment.
Right, now that means until you hit 20%, that's the lovely part of the conventional loan. Once you hit 20% ratio, which can be simply that your home value went up in price. This is you can call the bank and get rid of your PMI and say, hey, my house is worth, I bought it for $300, it's now worth $400. My PMI, I'm just making examples. My PMI should go away based on the new numbers, and your bank's going to have ways you can do that, whereas you cannot do that with other loans.
Exactly. Therefore, with the appreciation of your house, even, you can get rid of that, because it depends on the loan to value of your home.
Now, another con of the conventional loan is that you're paying your own closing costs. Exactly. Generally speaking, there could be some sort of deal made. However, generally speaking, you're paying your own closing costs.
Yes, but general rule of thumb, they say that is 3% of the loan that you get.
That's high, though.
That's going to be the general rule, but depends on which area of the United States you are living. But this is a general rule. Let's say that, for example, if you are looking at buying in Pitt County, North Carolina, a $200,000 house, 3% of it.
That's $300.
$300. We are talking about $9,000.
That's more.
Therefore, this is like a general rule of thumb.
And it's going to be cheaper than $9,000 if you're buying a $300,000 home here in Pitt County. It's going to be less. Just to give you an example. Yes. Now, let's talk about the next program, though, the VA loan.
Exactly. The VA loan, thank you for your service. And this type of loan, not everybody are eligible.
Absolutely.
Therefore, that is part of the eligibility. If you are active military or serve for the country, that is you. And
or surviving spouse.
Or is exactly. And you need certificate of the eligibility to show for your service to be eligible for this type of loan.
There is no credit score that's listed on the VA as required. So you can find, a lot of lenders are going to have guidelines on what the credit score should be. However, not all lenders are going to have that. So if you have a situation going on with your life, I would highly recommend you be honest and upfront before you have anybody run your credit score to say, hey, could you help me with this situation? Find someone who can help you, because the more honest we are, the more we can find people to help.
Exactly. And first, you can do basically from annualreport.com, get your annual free credit report and figure out what's going on with your credit. That, as my wife said, you can upfront share it with the lender or financial institution.
What about the features? Well, how much down payment do I have to have?
Well, this is a good one because of your service, government is going to give you the loan that is 100% financed. Means that you don't need any down payment for the house that you're buying.
And what about my interest rate? If I'm using
your interest rate usually, or most probably, is lower than the other three category of FHA, conventional, and USDA loans.
Another thing is your closing costs are going to be capped. So there's going to be fixed costs for closing costs, so it's not going to be based on various factors. And you can ask sellers to contribute sometimes with VA loans, but it's a set limit as well.
But which depends on the market that you are dealing with. Is a buyer's market or seller's market?
The lovely thing about it is that the prices for the closing cost is reduced. You don't have to have any down payment with necessary, and you can reuse this. I had a friend, she totally believes that she should never use her VA loan because it says one time and one time only, and she can never buy a second home, so she's been saving her VA. This is incorrect. The VA allows you to buy you can't buy multiple properties all at once, but you can buy one home at a time, and then you can sell it and get another one, and then sell it and get another one after that. So it's not just a one-time loan.
Does the VA loan also you need to pay private mortgage insurance or PMI? Okay, therefore this is also another benefit of the VA loan, that you don't need to pay that PMI, and definitely is very important.
Now, if you've watched this and say VA doesn't qualify, I don't qualify, move on. Well, here we are. So we're going to move on because not everybody qualifies for that one. So the next one we're going to talk about that everybody can qualify for is FHA.
FHA loan. Therefore, FHA loan comes really from the Federal Housing Authority, which came to help those people that they have a little bit of the lower credit score, because in conventional we talk about 620, in FHA we go up to 580.
Right. So I mean, but you have to put 3.5% down with the 580. So just so you understand, what's $300,000 house?
If it's $300,000, we are talking about $10,500 for the down payment for the FHA loan.
And if you are looking for $300,000 and you're talking about that kind of money, I could totally bring you to a new construction builder who's going to cover your closing costs. That will be all you need with that 3.5%, just to give you like ideas in my area of what's going on.
And what we should also mention about, beside that was the pros of the basically FHA loan. But in FHA loan, if we go with that PMI, we have the private mortgage insurance that you cannot remove, no?
Right.
Therefore, that private or premium mortgage insurance is going to stay with the loan term.
Now, the pro of it is like a conventional, well, no, not like a conventional, you can get a fixed or an ARM. Here, you're going to get a fixed rate. So it's going to stay, the payment's going to stay stable for the life of the loan, never changing. So if your situation improves, of course, your payments will be less percentages over time.
And we don't go to the detail of how much is going to be the closing cost. We have a separate video that you can see what is the closing cost of the conventional is versus the FHA, that you can watch that video. And the next thing that we wanted to cover basically is a USDA loan.
Right. The USDA loan is geared toward more rural properties. Now, when I first moved to my area, I had no idea what a USDA loan even was. I was like, well, what's that? I never heard of it because it wasn't available when I lived in big cities. Now, It's generally meant for more country areas. The population has to be lower, so they're looking to finance, and it's run by the U.S. Department of Agriculture, so USDA. So the same people who give the school lunches also can afford to help you with a mortgage, which I didn't know about. So I'm just throwing that out there.
Therefore, the best thing is every time that you wanted to purchase a property, depends on where in the United States you're living, you go to the website of the government and you see if your location or the house that you wanted to buy is USDA eligible location.
Now, your credit score generally has to be good. There's no exact number. Some loan lenders are 620, 640, but they generally want to see that you have good credit with the USDA loan.
Yes.
They want to see that you've been paying your bills in the past.
Exactly.
What's a major benefit?
Well, also the one that I wanted to add thing is about your income also is super important too. Therefore, for the household in our area, Pitt County, North Carolina, if you are 4 in your household, you're talking about $111,000 for household income.
So if you make more than that, you don't qualify for USDA
Therefore,
loan.
location is important, the population is important, and your income is all these 3 factors important that you are eligible for USDA loan.
Another feature I wanted to mention is that it's a 0 down payment opportunity. So you can walk into a house with no down payment. So we're not talking about 3.5%. We're not talking about 3. We're not talking about 1. We're talking about 0. So we're just talking about closing costs. And sometimes if the house appraises for more, you can include the closing cost as well.
Exactly. But in general, USDA loan is really close more or less to the conventional loan closing costs.
Now, I will say that if you've done one of those quick fix credit schemes in order to up your credit over time, the USDA loan does look at credit a little bit more long term. So they don't like the quick credit fixes. They look at a long term view of what's been going on with your credit. So it is not suitable. This isn't the loan type to fix your credit and then buy a home. The USDA loan looks at a more long game to see, are you paying your bills over the long term. So it's
Therefore,
not just like 6 months.
That is a question for your lender when you wanted to work with him about FHA or USDA. It tells you which one is the best for you, because let's be honest, USDA gives you 100% finance.
Right.
And that's a great benefit.
Okay, so we hope you love these videos. We love making these videos for you. Don't forget to hit the subscribe and like us and share a comment in the video.
And don't forget to call us at 252-327-3357 if you are shopping or selling property in Pitt County, North Carolina. We'd love to help you.